Hey everybody, welcome to Mortgage Today for Wednesday, August 30th, 2023, and oh, what a day it was. MBS were up 3 basis points in the first hour of trading. Stocks were flat. Bonds were weaker in the overnight session as steady losses in both Asia and the European hours. There was a distinct lack of connection between the EU yields and treasuries, with the former spiking faster and higher at the start of the EU session. Meanwhile, treasuries mostly plodded along at barely higher levels. When ADP came out weaker than expected, there was a very small, very brief improvement, but it was quickly back to pre-ADP levels. ADP employment came in at plus 177,000 jobs on 195 forecast. It was 324,000 previously. However, keep in mind they reformulated this like 5 months ago, so we might just be finding a new normal and doing some tweaks to it. But this is the smallest gain in 5 months. Job stayers saw a 5.9 increase in pay. That is the slowest growth since October of 2022. Job changers saw a 9.5% increase. GDP preliminary first revision came in at 2.1 versus a 2.4 forecast. It was 2.0 previously. GDP core PCE came in at 3.7 on a 3.8 forecast. However, this is the first revision. It's also good to keep in mind that the Atlanta Fed is predicting 5.9% in the third quarter. Second quarter GDP was revised downward to 2.1% from 2.4%. Consumption was flat at 1.7%. The PCE price index was revised downward as well, with the headline number falling to 2.5% and the core number, which excludes food and energy, falling to 3.7%. Residential construction continued to be a drag on GDP, extending its streak to 9 consecutive quarters. Given the action in the home builders, perhaps this is finally about to change at long last. Including the Fed rate hiking cycle of 1968, there have been 7 rate hiking cycles through 2008-2009 that ended in a recession. Over the course of those cycles, it's taken an average of 22 months from the first hike to the start of the recession. The fastest recession onset was 12 months, while the longest leg before the recession was 31 months. There were 2 cycles that didn't end in recession. This morning's economic data was bond-friendly, but not as unequivocally as yesterday's JOLTS data. The heavy lifting came courtesy of the first GDP revision for quarter 2, the total dropping to 2.1% from 2.4%, and some softening in PCE inflation for good measure. Bonds turned solidly stronger on the data and then spent the rest of the day losing a very small amount of ground very slowly. The net effect is still a victory in the bigger picture, but there were several negative reprices amongst lenders who'd adversely passed along recent market improvements. The aggression proved to be too fragile even for what could be considered a modest pullback in bonds. MBS ended the day down 4 basis points. Stocks were flat, closing the day at 98.71, which puts us right on this Fibonacci thick red retracement line there. We'll have to see what tomorrow's data brings for us. Tomorrow we are getting the challenger layoffs and the core PCE. Core PCE inflation is a big one for the Fed, so the market should react to that pretty heavily however it comes in. The market is forecasting 0.2 when it was 0.2 previously on the headline, and then core PCE year over year is forecast to be 4.2 on a 4.1 previous.